Hello, everyone, welcome. Today is lesson 1 of the futures market. Here's a question. What if you only have about $1,000 in the account, but you can control $10,000 worth of exposure? That is the margin system. Think of it like putting down a security deposit or a small down payment. You post a fraction of the full contract value as collateral and control a much larger position. But it is not only upside. Gains can be large, and losses can be just as large. That $1,000 can go to zero, and you can lose more. That is the scary part of futures. Today we cover the basics of futures, how margin works, and the most important idea of all, liquidation, the forced stop-out system. Futures are simply a binding promise. You agree today on a price to buy or sell an asset on a set future date. For example, I agree to trade the S&P 500 at 5,200 for a March contract. You are not buying the stocks themselves right now. You are locking in a future price. Look at the chart. ES1.
더 이미니 S&P 500 퓨처즈 컨트랙트.
It is a mini-size futures on the U.S. equity index, and the price is moving in real time. First big difference from stocks. Stocks are mostly buy then sell. Futures let you sell first and buy back later. If you expect prices to fall, you can short now and try to cover cheaper later. You can aim to profit on the way down, too. That flexibility is the appeal of futures, and also part of the risk. The most important feature of futures trading is margin, collateral you post with the exchange, through your broker. Margin means you put up only a slice of the full contract value as a security deposit, and that slice lets you control a much larger position, like a down payment that unlocks a house worth far more than the cash you put down. Look at NYMEX, CL1. WTI crude oil futures. One contract represents a large amount of oil, but under CME rules, the initial margin is only a fraction of that notional, and it changes daily with exchange rules and market conditions. That is leverage. You put up relatively little cash, yet you trade a much larger commodity position. If initial margin is about $1,000, you may be controlling $10,000 or more of oil exposure. So small capital can aim for large gains and equally large losses. Warning: always check the exact contract specs and current margin on the official CME site, https://www.cmegroup.com. What is the upside of leverage? The same cash can target a much larger P&L. Say you go long on this ES1 chart. Even a modest index move can, with roughly $1,000 of initial margin, sometimes produce several $1,000s of profit. That is the attraction. And the downside? The same size works against you. That $1,000 of margin can melt fast, and losses can exceed the initial margin you posted. Here is the key. Leverage is a double-edged sword. It amplifies gains and losses. Small price moves can become large account damage. That is why futures are dangerous. Without enough capital and a clear loss management plan, it is easy to wipe out the account. Now the scariest part of futures, liquidation. Liquidation is a forced stop-out. The clearing/brokerage system can close your positions automatically without waiting for your click. Your account is monitored continuously. If losses push your equity below the maintenance margin level, positions can be liquidated automatically to limit further loss and exchange/broker risk. Concrete case. On this ES1 chart, say you posted about $1,000 of initial margin and went long several contracts. Then the market drops hard. What happens? Losses pile up fast.
equity might fall from roughly $802, $602, $400.
Even if you decide to cut the trade yourself, the system may liquidate everything first. Warning: that is liquidation. It does not wait for your preferred exit, and the fill may not be the price you wanted. This is a core reason futures are high risk. Futures have one more trait stocks do not. Expiration. Stocks can last indefinitely. A futures contract ends on a set date. On this chart, ES1, E-N Pay 500 futures typically expire on the third Friday of the contract month, quarterly cycle, March, June, September, December. At expiration, the contract settles in cash for equity index futures like ES. Want to keep a longer-term view? Use rollover. Before expiration, close the near contract and open a farther dated contract so the directional idea continues. Example, as the March ES contract nears expiration, you sell March and buy June. Your long or short thesis stays. Only the contract month rolls forward. Warning: watch the price gap between months. March might trade near 5,200 while June sits near 5,210. That calendar spread can create extra gain or loss when you roll. Quick recap.
Futures are forward contracts.
Margin lets you control large notional with less cash, and losses scale the same way. The scariest piece is liquidation. The system can close you out automatically when margin runs low, often not at the moment you would choose. And because contracts expire, rollover management matters. Warning: with futures, you can lose your entire initial margin and more than the margin you posted. Futures trading is high risk. Education and a capital plan are essential. This lesson is for education only, not investment advice. No specific return is promised, and a total loss is possible. You own every trading decision. Next time we dig into concrete future strategies and how different contract types behave. If this helped, please subscribe and hit like.